Running a successful lawn care business requires more than just a passion for landscaping and a reliable mower. To thrive in this competitive industry, business owners have to master the financial side of their operations, and one of the most critical tools for this is the profit and loss statement. The profit and loss is a financial report that summarizes your revenue, expenses, and net profit or loss over a specific period, such as a month, a quarter, or a year. And for lawn care businesses, the profit and loss or the P&L statement is a roadmap to understanding profitability, identifying cost inefficiencies, and making informed decisions about pricing, equipment investments, and service offerings. This is a step-by-step approach to reading the P&L statement for lawn care business owners. The P&L, as you've probably heard it called, is also called the income statement. It's the pulse of any business's financial health, and it answers the fundamental question, is my business making money? For a lawn care company, the P&L tracks your income from services like mowing, fertilization, and landscaping, while detailing the cost associated with delivering those services and running the business. The statement's divided into key components. You have your revenue, your cost of goods, your gross profit, your overhead cost, and your net income. And by analyzing these elements, owners can assess whether the business is profitable, identify areas for improvement, and plan for new growth, such as expanding into new service areas or investing into equipment. First line of the income statement is the revenue, which represents the total income earned from services and products sold during a specific period. In a lawn care business, revenue typically comes from your residential mowing contracts, commercial property maintenance, and then you have your add-on services like aeration, leaf removal, or snow plowing. For example, a business might report $20,000 in monthly revenue, with $12,000 coming from mowing, $5,000 coming from landscaping, and then you have maybe $3,000 coming from fertilization. Now, to analyze your business revenue, compare it to previous periods to identify trends within your business. Lawn care is seasonal, so revenue often peaks in summer and then it dips in winter. And if your June 2025 revenue was, let's say, $20,000, but it was $18,000 in 2024, it's suggesting you have growth, possibly due to new clients or higher rates, but you also need to check for payment consistency. Are most of your clients on recurring contracts providing stable income, or are they one-time jobs skewing your numbers? Stable recurring revenue is ideal for the long-term planning of your business. Then you need to analyze your cost of goods by calculating it as a percentage of your revenue. So using the earlier example, we have $11,000 cost of good divided by the $20,000 in revenue, and that would give us a percentage of 55%. A lower percentage indicates you have better efficiency as more revenue is retained after your direct costs. So if your fuel costs are rising due to market prices, you got to maybe explore some bulk fuel purchases or maybe fuel efficient equipment to reduce this expense. And similarly, ensure that your labor costs align with your service hours. If crew members are paid for 40 hours, but then they complete the work in 30, productivity might need improvement through training or better scheduling. And a high cost of goods can erode your profits. So, controlling these costs is pretty critical. Next, you've got your gross profit, and it's calculated by subtracting your cost of goods from your revenue. So you got 20,000 minus 11,000 cost of goods equals your $9,000. And this figure shows how much money remains to cover those overhead costs and then contribute to the bottom line. The gross profit margin is calculated as gross profit divided by revenue. So 9,000 divided by 20,000 equals 45%. And it's a key indicator of service profitability. In the lawn care industry, your gross margins typically range from 40 to 60%, just depending on the service mix and efficiency that you have going on. Next, you got to compare your margins across service types. So mowing might have 50% margin due to low material costs, while landscaping has a 60% margin just because of the higher pricing. If fertilization margins are only 30% due to, expensive chemicals, you might want to consider raising your price. Declining margins over time may signal rising cost of goods, or it could also signal inadequate pricing. For example, if fuel prices increase, but then service rates remain static, your margins are going to shrink. So regularly reviewing gross profit helps owners prioritize high margin services and address cost issues, very promptly. Next, you have your operating expenses. These are indirect costs required to run the business, but not specifically tied to services. And these include your administrative costs like marketing, insurance, depreciation of equipment, and then your salaries for non-service staff like an office manager. So let's suppose you have operating expenses totaling $6,000. You got $2,000 for insurance, $1,500 for marketing, $1,500 for administrative costs, and then $1,000 for depreciation. Categorize these expenses to identify your major cost drivers. So if your marketing's 25% of your operating expenses, evaluate its return on the investment. Are, maybe your ads generating new clients, or could your funds be better spent elsewhere? So compare expenses to industry benchmarks where operating expenses typically account for 20 to 40% of revenue. In this case, $6,000 is 30% of $20,000, which is reasonable, but it leaves a little room for overspending. So you need to look for cost-saving opportunities, such as negotiating with lower insurance premiums or getting started with lawn care launch to help lower your back-end cost. And keeping operating expenses in check ensures more gross profit flows to that bottom line. Your net income is the final measure of profitability, and it's calculated as gross profit minus operating expenses and other costs like interest or taxes. So pulling from our previous example, 9,000 COGS minus 6,000 operating expenses equals $3,000. And if the business has 500 in interest and 500 in taxes, your net income then drops to $2,000. A positive net income indicates profitability, while a negative figure, it just signals a loss. So then you have your net profit margin, and it's calculated as your net income divided by your revenue. So $2,000 profit divided by 20,000 revenue equals 10%. And then this is just going to reflect your overall financial health. So a healthy lawn care business often achieves net margins of 10 to 20%. And if your margins are below this range, you need to investigate the cause, like low revenue, high COGS, or excessive operating expenses, could be to blame. For example, if your net income is negative due to high fuel costs, consider raising those prices or optimizing routes to reduce your travel time. Net income is the ultimate gauge of whether the business can actually sustain itself and then grow from the pure profits. Lawn care businesses are seasonal. You get your revenue and your expenses fluctuating throughout the year. Spring and summer bring high demand for mowing and landscaping, while winter may see reduced activity unless snow plowing or other services are offered. So compare your P&L statements across multiple periods to understand these patterns. If your net income is strong in June but weak in December, plan for off-season cash flow by saving profits or just diversifying your services. Historical trends also reveal growth or decline. If your revenue grows 10% annually, but your cost of goods rises 15%, your profitability might actually erode over time. And seasonal analysis helps owners budget for equipment purchases or hiring during peak seasons and avoid overspending in slower months. For example, in investing in a new mower in winter when cash flow is tight could really strain your finances unless you plan that carefully. P&L is not just a report, it's a tool for action. Use insights to adjust your pricing, such as increasing rates for low margin services like routine maintenance, manage costs by negotiating supplier contracts or investing in fuel efficient equipment, and really focus on upselling additional services to boost that gross profit. And budget for growth by allocating net income to a marketing plan or investing in equipment. And Lawn Care Launch can really help you pick apart your P&L through our prepared monthly statements, monthly Q&As, and with our years of experiences working within the green industry and the professionals. So we're really set up to tackle any questions you might have. Click that link below to head to our website and hit the Get Started button to join today. Reading that P&L statement is a vital skill for lawn care business owners seeking to maximize their profitability and plan for growth. And by systemically reviewing revenue, cost of goods, gross profit, operating expenses, and net income, you as the owner can identify strengths, address weaknesses, and then also make data-driven decisions. Seasonal trends and industry benchmarks provide context for interpreting the numbers, while back-end help from Lawn Care Launch can help drastically drop your overhead cost through our bundled professional services. And ultimately, the P&L statement empowers owners to transform their lawn care business from a labor-intensive operation into a financially sustainable enterprise. By mastering this financial tool, owners can cut through, the noise of daily operations and cultivate a thriving and profitable business.